All right, Joe says, for legs, measuring trade potential for day trades, he says, I know you're always aware of things like 10-day high and low, but for a trade that is only intended as a day trade, do I include legs from previous day to measure potential moves? Do I include overnight gaps? Uh, yes, you could do that, but in general, this is what I mean. In the new day, the previous support and resistance I is reflect the size of yesterday's legs influences me. Like if this is day minus one and this is today, and I see, yesterday was something like this with the RL10. I'm not taking the size of that leg and then bringing it over here and saying, hey, this thing that's right here could actually move that far because that's how far it moved here. What I'm actually doing is saying that this was a decision point where it got that far and failed. So if I happen to be here where this was, yesterday that thing moved here. But if it doesn't go that way and starts moving that way, the first place that statistically it failed yesterday was here. So I think from where I am at the critical state, it could move that far. So I'm not actually like measuring all of these moves and then somehow coming and say, here's the composite size of the average move, and then saying from there it could move that far. I'm actually looking at where the turning point was. Where was the price physically that prompted the change in behavior? Yesterday it went from here and it got that far, and that's where it failed. And then it stalled right where it stalled today. Oh, that's interesting. It stalled today where it stalled yesterday. And yesterday it decided to move here. Yeah, but it's actually moving here. Let me try to clean that up. It's actually moving here out of this circle. It's moving this way. So I just say, how far could it go? Well, yesterday it was moving up until it failed right there. So that's how I measured the size of the leg. So it's actually influenced by those. And I would tell you that you get a feel for how far these things move. But even more important than that visual is the idea of the range stat, which is the aggregate description of all of those moves for the last 30 days. And then we've broken it into 10 chunks. And so when I'm actually looking at this, I'm seeing that as there's the amount of risk I was taking. And until that next level, there's 3 of those into 1. And I'm basing that on this readout and the size of that box and how far it could go, and then where those support and resistance levels from yesterday project into today. That's sort of that aggregate. Another way that I do that is on that time frame, there's the RL270, which is the aggregate price of the last 270 periods. Wherever those dots were where it closed, that's where the 270 regression line predicts is the proper price. And it just so happens that I'm down here with the RL10 where the actual price is. And then I can take that risk box and say, yeah, it turns out that there's an imbalance of 6 boxes between how they feel and how it is. That influences me. But again, I'm using the risk box as the unit of measure of standard moves. Right? So if I sort of backwards analyze my way into that, because otherwise Imagine if I was trying to do that live, I'd have to say, well, yesterday there was this size move and this size move and that size move. How far is it going to move this time? And if I were to try to dynamically integrate that in my head, I couldn't do it. Not reliably without second guessing myself. So the actual things that I care about was where was the turning point? And that has everything to do with why I use the RL10 equals price. I actually believe that. Those price levels where turning points occurred matter to me because I'm trying to express that distance in terms of standard units of measure. And then if I can use those as my risk and my give back, now in this scenario, if I can get an entry here with that much risk, if I could get the 3 in the middle and give 1 back, man, I'd really be happy. And now if it actually starts moving and starts failing, I can compare how much do I have versus how much I was willing to risk. And then my decision is, as a practical engineer, how can I get my original risk out of the equation and lock in the damn no lose plus dinner for 2? I do that on every single time frame because what I have is some theory of how the world works, and I have a hype, and that gets expressed in a very specific hypothesis about this trade and why I have reasons to believe that when I set up that frame, I get favorable reward to risk according to the theory, according to how I've set up the experiment. But the practical part of me says, don't lose money. So yeah, I have some theoretical reasonable target that's predicted by the theory as being a reasonable gain in this short period of time that I'm going to hold it. And during the time while it is reasonably moving along, I also hypothesize that there will come a moment when I can go from risk on to risk off. And if I can do that over 1,000 trades, then I'm going to be good to go. And I will gather the data from those 1,000 trades to go back and adjust my trade template according to continuous improvement and statistics. And that by doing so, I will leave the herd and the way they make decisions behind, and I will act in a professional way. And I think that there's one professional for every 99 herd members. Oh, let me tell you, I actually think it's 1 in 1,000. I actually think it's 1 in 10,000. Genuine professionals compared to people who make decisions on the basis, they think they're making decisions on the basis of thinking. I think they're making the basis of feeling. I also think that between the herd and true professionals, that there is a hobbyist, and then I think there's gamblers, and I think there's novices, I think there's journeymen, I think there's meisters, and I think there are genuine artists. And a gambler is a guy who lies to himself, who says he's somewhere else on that curve when all he is that. and he bullshits himself, or he's not even aware of it. And I also think that if I were to put some kind of percentages on that, I think 99% of the world that's in the market acting is genuine herd who haven't even thought that much about it, but act on pure impulses in times of crisis once every X number of years. This guy was told buy the S&P or whatever it was, buy the S&P 500 and by his dad, so he did for 30 years and then it lost 50%. So he makes one impulsive decision to get out along with millions of other people and never returns. And then I think there's all these other guys. Anyway, that's why I rely on statistics, and I want to be around for 1,000 trades, and each trade that I make is just one of the next 1,000. So you need to know that about me because I give you advice on that basis. Just being transparent here. In the video course in 2019, I said my average win is 0.6 based on your trade posts. It looks like I'm getting better. Yep. But I fixate and I act on it as if I'm at 0.6. No matter where I am on the actual curve, as long as my average R capture, and that's measured in terms of execution risk, as long as I'm better than 2 to 1, I'm good to go. And anything better than that is icing on the cake. And I just say I attribute that to luck or the market is trying to tempt me with riches. I think there's some carnivore out there who wants me to keep scaling more and more risk on the bet. And I just say, look, as long as I can get that, I'm going to act as if I'm getting that. And all you're ever going to get from me is the amount of money that's justified on the basis of I can achieve 2 to 1, even though I may be getting better. And so there are some guys who tell me, well, you are such a coward that if I was you, I'd be investing more, and why aren't you investing more? And I'm saying, why are you even saying that to me? Why do you care how much I risk on my trades for my goals and objectives? Why is my behavior on this? Why is my decision on how much to risk bothering you enough that you're trying to change my behavior? You have no power over me. I don't even listen to you. You go do what you think is best for you. You just let me do what I do. How about that? Because I know guys that will take a look at one trade that was, hey, today you got 10R and you could have had 20R. And if I could get 20R every day for 5 days a week, times 52 weeks a year, times 50 years, they act as if that was the baseline, and then they project that forward. And they say, I see you only risked 1/10 of 1%. And if I risk 3%, I could be 30 times larger, and then I could get 20 times 5. And they start projecting as if that's their expected returns. Do you think a guy who thinks like that can trade the way I trade? No, he cannot. Because he's just going to blow up. So, yes. I behave on the basis of 0.6 to 0.3, not just for psychological reasons, but because I believe there are tigers out there that want to get me every day. I live in mortal fear of that. Oh, wait. This one here. I was thinking that all core positions started as day trades, become swing trades, and then become core. Day, swing, core. That it always starts here and then progresses through success there. But sometimes, based on the foundations videos, it looks like maybe it could go straight from day up to core. And that I will often use those same symbols from day and swing. Yeah, except it's a little more complicated than that. I think of a core position as a swing that has gone so far beyond my initial risk that it's boring and mechanical. But some of the core positions started as swings first and were never day trades at all. Like, I've got a natural gas, I own some natural gas shares and some silver shares that the entire position was paid for, not just the risk on it, but 100% of it was paid for purely with markets money. And I put that in a lockbox to give to my kids with a 200-year time horizon. And I say, never, ever sell those silver coins. Never. Because those were a gift. So I inherited some silver coins from my grandfather, which he got from his father. And I'm never getting rid of those things. So, in some sense, the core, that's almost like beyond a core position. I suppose I should call that a legacy position. But there are some positions that I day trade because in my core swing and day trading portfolio, about 20% of my money is here. And I act on that on the basis of the rules that the core system tells me. So I know I'm going to hold that for a month with a 10% trailing stop. But that has so much relative strength compared to the other things that in the 40% of my money that is devoted to swing trading, I'm also ready to use that symbol as a swing trade on its own merits. Because I'm already interested in it and I have reasons to believe in it. And then anything that is on a swing trade with 40% of my money, which is always cash overnight, I'm willing to day trade it. Now, there are some things that I trade as day trades, like EWZ, Brazil, that if that trade is really working well, I'll hold it as a swing trade. And I might hold it as a core position if the core system tells me to. But this thing actually goes in both directions. The relationship between day trading, swing trading, and core trading. The more important logic, in my view, core, swing, and day, is that 20, 40, and 40. So the maximum overnight risk, if I'm all in on the core, and if I'm all in on my swing trade, that's a maximum 60% overnight risk. And that's when, right now, this is zero. Unless there's a day trade and I have markets money and it says I can take the overnight risk, that's the only swing trade I got going on right now because it's bearish volatile. So that crap is cash. And the only overnight risk I have is coming out of that one because we're in bearish volatile. Any short position I ever have is always tactical in my mind. It's only from my day trading portfolio. I never swing trade from my swing trade portfolio short. I never do that. And my core position is never short. Next question. From the 5 days down, the initial target is back to the 5 day high. No, it's always like to the 10 day. When it comes to computing the reward to risk on swing trades, so this is 1, 2, 3, 4, 5 days down. Whatever the 10 day high is, wherever that is, maybe it was here, maybe it was whatever that is, the reward to risk ratio for me is always this compared to that, 4 to 1. Now, when it comes to the actual execution of that trade, I'm trying to get the blue color on this. Yeah. And this was the frame. When it comes to where to place the stop, as I go up the stack, I know that this is the theoretical target, but all I care about there is where is the stop every time, and that's always a function of like support and resistance and R's and the distance and the timing. So that's always a tactical stop that's given based on where the actual support and resistance numbers were and where I could put, and what it comes down to eventually is once my risk is out, there was the PSAR and it got above my entry and I was able to get my stop to no lose plus an enter for 2. At some point, it's the Bollinger Band mean, or it is the PSAR. It is the southern skin of the dragon, the spine of the dragon, the upper skin of the dragon, or like a 1 day low, or a 1 bar low, or a 2 bar low, or the edge of the dragon, the spine of the dragon, the southern skin of the dragon, the PSAR, or the Bollinger Band mean. So where the stop is a function of what that looks like and how much I'm giving back, how much I'm keeping, and how much I'm giving back compared to the maximum gain. So that decision is based on how much give back versus how much am I locking in. And that's on every time frame except the core. The core is 10% from highest high, just because. Unless it was better than plus 15%, then it's 5%. But it turns out in the core position, if I'm holding 15% or better, it's a 5% trail from highest high, which is way wide, right? So like if that was Tesla, and if it's in the core, and whatever, maybe it was, I forget what the number, 350, then that is about a $12 stop. But otherwise, once I get my risk out, where the actual trailing stop is right there. But in terms of the trade frame, when I'm framing the trade frame for swing trades, all it is the mechanical reward to risk ratio is the range risk compared to the 10-day high. And as long as that gives me, I don't know, 2 or 3 to 1, then it's good enough to get started, and then I'm adjusting I'm adjusting the stop. Have I over answered that one sufficiently? Probably. Okay. Um, Execution risk versus position sizing risk based on the mental state management or 2 to 1. Let's see. Yeah, I think I've answered that one. It's really my 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 position sizing risk simply is saying, look, it be 5 times smaller than you think you have to be. Whatever the trait, whatever the logic was that said you could get long here, and that hypothesis fails right there. As long as I got 2 to 1 there, I'm probably okay because I'm going to get my risk out of there pretty fast. And all I'm saying is, instead of calling that 1.0 and then deciding how much money and how many shares to trade, I'm treating it as position sizing risk. And then that means this is, if I made that 0.3, then if I get 2R, it's 0.6. And that's really 2 to 1. And that logic. So when you see me on you've seen recently sniper trades of the day get like 5 to 1. A 5R win on that sniper trade of the day is based on execution risk and R capture. Because I actually want to know on the quality of the trade frame that I put together, how much am I actually getting compared to what I was actually risking? So if I get 5 to 1, in terms of how much money I made, if I made that like 0.3 or 0.2, it's 1 full R for position sizing risk. But let me tell you this, if on a weekly basis, if you can net 2 position sizing risk every week, that's 100R a year. So I'm concentrating on improving my technique on the basis of execution risk, but I am protecting myself, and that makes me be very aggressive about how small to make the risk. So I'm just making that, I am protecting myself against my aggressive nature by making that only 0.2 or 0.3. So as long as I can get on execution risk 0.6 versus 0.3, 2 to 1, that's all the better I got to be. But I'm better than that, if I'm being honest. But I'm not, I'm treating that as an anomaly. I am strictly trying to make sure that I can get 2 to 1 or 0.6 and 0.3. I am just a real coward when it comes to that. Let's see let me continue on.
Would it be possible that I can jump in and ask a question
Yes,
regarding
sir.
the execution?
Yeah.
You mentioned in a previous video that you would risk 60% of the execution risk and extend the MMRB, right?
Wait a minute.
So assuming your
Oh
execution
yeah,
risk,
yeah, yeah. Oh yeah, yeah. It gets even crazier. Okay, so on a case, and this is where it can get so damn dangerous. So as you know, that little pattern right there is the PSAR flip, right? And on day trading only, it's not unusual for that to be, in terms of the MMRB, the PSAR, let's call that the PSAR box right here. And then over here I have the R10, which happened to be 1/10 of the range stat. Now, one of the things that just astonishes me is that about 80% of the time, 1/10 of the range stat, I'll be damned if it's not so close. You just can't believe it, how close it is. But sometimes, and I'm going to do it in purple, sometimes that R10 is like this. And I'll take that as 0.2. And the trigger that gets me out is always going to be that one. Because that's it's going this way, and when it flips, I should be collapsing dragon. And maybe that is that could be 0.6 of a range stat, which is, and so that tells you how much risk I'm actually taking. And my standard risk is $400. So that might be 5,000 shares of EWZ. That's a large position. And if I'm trading on a 3-minute chart, can you imagine a circumstance in which there could be some hiccup and for some reason I can't even get out to here? Yeah. So $400 is not a large number compared to the portfolio value. But I don't care. Well, it's not an efficient use of your capital based on rational. Hey, maybe this is the 1 in 1,000. Yeah, maybe. That could be. So I'm a chicken shit. You got to decide, and that's why I say, what percentage of dollars per trade is based on your fear decision? And I don't mean that in a negative, disparaging way. That's the most important. That guy is the one that protects me against tigers. My rational brain is the one that says this PSAR risk box is the reason, is the signal to, instead of going long, to go short. That's my rational brain. I know that. My fear brain is the one that's protecting me against the 1 in 1,000. Because I've survived 40 years. I intend to survive 200 years. I don't know that this is maybe this is where we get functional immortality with AI, and I don't know. If not me, then my son, and if not my son, then my grandson. So I'm respecting fear. Does that answer your question?
My question was actually a follow through in terms of the 2 hour battle drill.
Ah, yeah,
So
yeah.
let's
Yeah.
say your execution risk is $100, but then your actual
Yeah.
risk in the trade is $60. Would
Here's
you?
here's exactly how I do it. Whatever the actual signal to exit is, like if that's the signal that gets me out, the 2 hour battle drill is this one. The actual trigger to get out, the 2 hour battle drill is based on that one. Independent of dollars and all that other shit, it is purely, I'm betting that I can reasonably get to 2R And while it's doing that, somewhere around point 0.6, I'm getting to no lose. I'm getting to no lose plus dinner for two. And then by the time it gets past 2R, now I can think about a second position because I protected myself against actual portfolio dollars lost. 100% of the time, the 2R battle drill. Now, my brother goes absolutely berserk with that, and he adds routinely 2R, 4R, 8R, 6R, and he gets 1, 2, 3, and 4 and goes. I almost only ever get a second position, and I'm already scared shitless. But I'm 66, and he's 57. So he's a young man.
If I can jump in as well,
Yep.
do you become more lenient with your no lose plus dinner for two in the second
No.
position when you
Nope.
added?
Nope, never.
So you let it
Yes.
rest for a bit as if there's a yellow box as well at the 2R position.
Yeah, and really because otherwise it just emotionally, and this is me. If I get the plus 2R, I am so happy and relieved that this is amazing. The real reason is I'm now going to get a sniper exit, and I'm really going to work the individual charts, like 1 bar low, half an hour loss, or whatever. That is really tight and focused. And I may be getting rid of the other open positions on day trading on 3-minute charts because I really want to concentrate on that. But when this thing gets past 0.6, not drawn to scale, sorry. So, that should really be like about here. My sense of emotional relief of locking in a 0.6, because remember, if it gets to plus 0.6, I'm locking in probably 0.2 or 0.3, right? So I have some little fraction. And then I'm not doing anything until it gets up to 2. And then what I'm doing is I'm trying to simply to continue to refine that until I'm up around 2R, plus 2R, and I'm probably locking in 1.75. And I'm only really risking that tiny little bit. And now I have my first position and now my second position. And that thing, if it gets me out right there and I lose minus 0.25 on 2 positions, I'm losing 0.5 and I'm netting 1.5 of my original win. Check or hold. You see that? And then when this thing moves up 0.5, and then I can get this thing, I can get this thing. Come on, dummy. I can get that one locked in. Now, on the second position, I've got maybe, call it 0.3. And this one at 2.3. Now I'm at 2.6 total. And now every time it goes up plus 1, I'm earning plus 2. And then that thing is just off to the races. Okay? And then I am such an emotional wreck that it's hard for me to get the third and the fourth position in because of my emotional sensitivity. And I would actually rather have 2 positions with 2 Two trades with two positions and there's my four. There's my 4 units of risk. My 4 bullets, and that's all I'm trying to get. That's on the 3 minute. And meanwhile, on the 30-minute bars, I could have 10 things cruising along because that's really my swings. It takes me 1 to 2 minutes every 30 minutes to make those little decisions. And then it takes me about 4 minutes every 30 minutes to go through all 30 of the things that I chunk, and make the adjustments and slip. And then I can only handle about that much on the 3-minute bar. And then every set. And then in the first 30 minutes of the day, I'm just trying to get started. And then there's the morning, and then there's the lunch, then there's the afternoon, and then there's the last 30 minutes. So I've got 4 30-minute bars in here. I got 3 90-minute or 3 30-minute bars at lunch when things are quiet, and then I got 4 in the afternoon. Then there's that last 30 minutes of craziness. So that just works for me, and it allows me to be routinely behaving and deciding with so little risk on any individual trade that I can just make a craftsman professional decision, that I'm not betting my entire fucking family, pardon my language, I'm not betting my entire the estate. And so that's what I would say on that. Okay. On a Z3 pinch, %80 of the time, the channel is so tight, it's really. Oh, I know. Let me fix this. I appreciate your patience on this, by the way. Why in the hell? View. I can't figure out why this is. View. Let's see. Trade logs. We're almost done here. Let's see. Do I do any other software? When it comes to like trade logs, I mean literally, I use paper and a pencil, and I'm just tracking each little R multiple of it in pencil, and then there's sort of the daily aggregate, and that's just pencil, and then I put it into Excel for the daily score. And then in terms of trading journal, I mark those up using Snagit to come up with what the net was. So hey, this thing risked that, and it came up, and it was a 5R win or whatever. And then I just record that, and then I keep those. My case study potential is really just one big. I got probably 20,000 case studies in my in a in a in a formula subdirectory, like under, it'll say trading, or tortoise, trading, results, day trades, swing trades, core trades. Then each one of them, there's probably 20,000 case studies that are one in PowerPoint pasted in there, and it says, hey, this one was 5 ring, and it says like, hey, 20, 23, 10, 28, and this was maybe a frog pattern, year, month, day, symbol, series, and it might be 5 little back and forth is on there, and it said, and the net result of all 5 of those was 5R. So that one slide, that one image, has everything, like the sniper trade of the day has everything. If it says 5R, then there's one, just an Excel spreadsheet for day trades that has the name of the trade that's unique to this, and it says, yeah, that was 5R, and then all of those, and then I use that to come up with the system portfolio picture, like the overview and the portfolio fund, and so that's it. I mean, it is very primitive, and any self imagery or self learning lessons learned and all that, I put onto the chart, so I learned that. So there are the trades. Then there is the dollar and number stats for expectancy. Then there is a learning journal which says, when I'm doing the plan, prepare, execute, and assess each day, when I said, and I review that, maybe there were 10 trades, 10 charts of pictures, the case study. And as I look at all that, said, well, this is what I did well on planning for today, and that's what I was poor on planning. Most of the, myself, this was very well planned or prepared, and this was, I didn't prepare very well, or I made very good decisions, and I almost don't even care about that. These were some bad executions. And then I say, look, on the things that I want to improve on, I'll pick, these are the things that I could do to be better. There's 3 things I could do and 4 things I could do on a plan, on a prep, and now I'm going to pick two things tomorrow that I'm going to be better at. So that's my daily AAR. On the learning journal, those things go into the learning journal, and then I have like an action list of, I said I was going to do those things, and these are the ones I actually did. Did I actually do the things I said I was going to do? That's what I do weekly. So there might have been, there were 5 things that I was going to improve my daily. Then on the weekly, I said, did I actually do those things? And then monthly, did I actually do my weekly improvement? And overall, how am I doing? And then on the monthly, I take a look at the dollars and the numbers and the actions. So there's really 3 parts to my monthly trade. What's the portfolio look like? What is my expectancy rate? Am I actually doing the after action reviews daily and weekly? Am I following through? And monthly is sort of my reset and fix the neglected shortcuts. You know, how am I doing really? And that's what I talk with monthly with Trader X. He's my pro money manager. And, you know, and I try to just forgive myself and genuinely just start a new thing altogether. And that actually is important to me. The monthly is my long-term one because the core portfolio, I take actions on a monthly basis on the 20%. So I have to do that. So on the monthly basis, I actually have to think of the core, the swing, and the day trading. And that, so the monthly is how I get everything completely reset and integrate the way I'm thinking about core, swing, and daily. And that's how I reset my brain. And then at the end of the month, any money that I made is officially mine, and that's where the 20, 40, 40 reset occurs. And I usually make more money out of day trading than I do out of swing and core. So this is where I take money out of the day trading portfolio and grow the swing and the core portfolio longer term. This is where the energy and the money is. That's where the value is coming to me when it comes to my overall, say, total portfolio. That's what I was trying to say.